ICT traders are struggling in 2025, where their once consistently profitable trading models are now leading to loss after loss. I worked with AI to understand exactly what is the difference between the 2025 markets and the 2024 markets, so you can understand why your trading strategy might be suffering and you can start thinking about what you need to do in order to improve it. So I used the ChatGPT o5 model. Now, I asked it, why are traditional ICT traders struggling in 2025 for index futures compared to previous markets? Though I don't follow many people on X, I do see random posts where people are saying my trading model is now broken. So stick with me and I will show you exactly why the markets are different and what PDRAs are no longer holding if you trade traditional ICT smart money concepts. So firstly, volatility has increased in 2025 when it comes to index futures. So there's been a volatility surge. 2025 has seen a notable rise in the market volatility compared to the calm of 23-24. 23-24, 22, super easy trading conditions. The Biden years were the easiest trading conditions I have seen in my career as a trader. But the Trump era has been different. So the VIX index has been averaging 21.4 in 2025, which is much higher than the 15 to 17 range in the prior 2 years. So in fact, the 2020 lockdown shock of the 2022 bear market had the highest volatility in the last 8 years. So the first issue is we have major volatility in the S&P 500 and NASDAQ compared to previous years. So the NASDAQ is experiencing larger daily ranges. This jump in volatility has returned the market to a more turbulent two-sided state. So this is very, very important. Now you're going to start understanding why ICT traders are struggling, because they are seeing choppier price action. So ICT traders report that the index futures market feels less orderly in 2025. In previous years, a strong higher time frame trend often meant relatively steady intraday behavior, with indices grinding upwards on shallow pullbacks. By contrast, 2025's environment is producing two-directional intraday moves. So what does that mean? ICT traders call that seek and destroy days, where both the session high and the low get taken out as the market hunts liquidity on both sides. This pattern reflects heightened stop run activity. Liquidity pools, clusters of buy stops above highs and sell stops below lows, are being raided more frequently before the market establishes a sustained intraday trend. So because we are having stop runs on both sides before the real move takes place, many traders get caught out. Okay, you may be bullish first and you get taken out, and then you're bearish and you get taken out again before the true move happens. And as many smart traders do, is if they rack up a certain number of losses in a day, typically 2, they stop trading. This is the problem, right? Where you're getting taken out on both sides of liquidity, and then the true move happens once you've already depleted your capital for today. So many traders note that familiar patterns like the Asian session range and prior days highs and lows are still key reference points, but the follow through after liquidity sweeps has become less predictable, requiring more caution. Volatility can spike around economic data or policy news, leading to fast stop runs that clear out retail positions on both ends before the true move occurs. So now you need to start backtesting to see whether you have a range created, both sides are taken before the true move happens. Okay, this is some great insight that you can start backtesting. Market structure shifts. The underlying market structure of indices has also been erratic. Traders in 2025 have observed more frequent market structure shifts and false breakouts. For example, an index future may break a prior day swing high, normally a bullish break of structure, only to reverse sharply and then break the opposite low soon after. So this is where your fib replacement, your 618 and 786, doesn't work, okay? Because you're expecting a retrace to the discount of a range if you're bullish, and then you're looking for some kind of lower time frame long, but then it's taken both sides of liquidity, okay? And then where are you? Okay, the market structure shift is no longer there. It's no longer clean. So this is what you have to start understanding. Now, If you would like access to this full report, all you have to do is find me on X, send me a DM and say, how has 2025 differed? Please send me the report and I will send you this PDF because there's a lot of information in here. It compares the bear market, the recovery, the low. There's a lot of information in here. Now, liquidity, order blocks, and smart money patterns. So ICT traders center their strategy on liquidity, identifying where retail orders are likely to rest and anticipating that smart money will drive price to grab that liquidity. In 2025, these liquidity concepts remain crucial, but the way price interacts with these levels has changed subtly. Traders observe that liquidity grabs are more pronounced now. Index futures will often overshoot the liquidity level by a wide margin before reversing due to the overall higher volatility. So you're not having shallow stop runs anymore. It's really going way past your daily high or daily low or session high or session low and then reversing. Okay, so let's say it takes the high of the day, it keeps going. So you think, okay, now we're bullish, and then it will reverse, where before you would have a subtle stop run and then you can get in quickly. Order blocks and fair value gaps, essentially price zones of institutional buying and selling. In prior years, once an index broke out, it often respected the last down close or up close candle, the order block. In 2025, the momentum is less persistent. Order blocks are less reliably honored unless confluences line up. So the key point here is don't just trade those higher time frame PDAs blindly. You need to look for some extra lower time frame confirmations. Okay, similar with fair value gaps. There's a lot more fair value gaps on intraday charts, both bullish and bearish, within the same dealing range or within the same price range. ICT traders still look for price to retrace and fill these gaps, but they comment that not all gaps get filled in one go. Some remain partially open as the market whipsaws. So under the Biden era, my fair value gaps would wick into buy like one tick and then just take off. Okay, now you have to be a lot more patient. You have to leave your trade open. Don't be so aggressive to setting your stop loss to break even, because that fair value gap may be hit many, many times before those pending orders are fully taken, before it takes off. Okay, so you have to understand that fair value gaps are also different. So what you really have to do now is back test on whether you want one stop run, if you're a stop run and you're a raid trader, or you're looking for two stop runs first, both the buy side and the sell side taken before the true move takes out. This allows for more traders to be taken out before the smart money traders come in and make the real move. There's more fake outs, there's more choppier conditions, but there is still money to be made. Now, what are the macro drivers? We have a new administration with policy uncertainty. Trump can tweet things over the weekend, which changes momentum. Tariffs have changed metals quite significantly, and the trade war in China have changed the revenue models for big NASDAQ companies such as Nvidia. So this has changed the market somewhat. Persistent inflation and interest rates haven't fallen yet. There's uncertainty in the energies markets. Gold keeps pumping as the faith in the dollar is falling. So there's a lot of macroeconomic conditions which are also affecting the markets, as well as the recent government shutdown, where you'll wait for economic news to happen, such as Thursday, 8:30 a.m., we have the unemployment claims data that usually comes out, but it hasn't been coming out for a while. So a lot of the big traders are just sitting on their hands because they trade off of data. They trade off of reports. And when the reports aren't there, it's a lot harder to justify those big swing trades. You will find that these higher time frame fair value gaps are not holding. Institutional traders aren't holding positions so much as they used to. Instead, they're taking short bites out of the market. So be less aggressive in your TP targets during these choppy conditions, okay? Because it can go and it can reverse quite sharply. Be happy with a 1 to 2. You don't need a 1 to 5 or a 1 to 10 that you see on social media. If you would like me to teach you exactly how I trade the index futures, metals, energies, forex, and crypto markets using my golden bullet and rabbit hole models, there's a link to my mentorship in the description to this video.